Good morning from our global headquarters in New York City. I'm Matt Miller in for Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Bond market warning. President Trump's tax plan triggers a broader risk-off tone, and there was a bad auction as well. Wait and see. Jamie Dimon tells Bloomberg the Fed is right to hold and warns himself of stagflation. Plus, an OpenAI acquisition. The company will buy an AI device startup co-founded by an Apple veteran, making a push into some kind of magical new hardware. We don't know what it is yet. In terms of the markets right now, S&P futures are up just 0.1% after a really bad day yesterday. Maybe not so bad in percentage terms. It wasn't a 2% loss, but it was 485 stocks down, the second worst breadth of the year after April 4th. NASDAQ futures bouncing back as well, up 0.2%, and the small caps also gaining. For some of the stocks to watch, let's bring in Bloomberg's Joe Easton. Joe, what's on your radar?
Morning, Matt. So take a look at Manchester United shares in the pre-market after this game. Last night we were all gripped to the club lost the match against Tottenham Hotspur. Tottenham Hotspur getting their first trophy in 17 years, and Man United now missing out on the Champions League, on the extra ticket sales, on the extra players potentially coming in, and the 2.5 billion euro prize pot. So a football mover to start the show off. And then over in the data sector, we've got Snowflake looking a bit more positive, some strength in their orders. Their orders up around 25% in the last period for the cloud company. A bit of an AI boost for that one as well. We're up 9%. But that gain is actually surpassed by Urban Outfitters over in clothing retail. The namesake brand doing really well, performing, flying off the shelves, according to analysts. Urban Outfitters, we're seeing that stock gaining around 18% in the pre-market today, Matt. And as usual, all these stories will be on the Before the Bell opening wrap on the Bloomberg terminal shortly.
Yes, I have to thank you, actually, Joe, for Before the Bell. It is a gift to those of us in New York
shout out,
getting up early. Joe Easton there out of London. In just a few moments, we're going to speak with Katie Magee of JPMorgan Asset Management, and then later in the hour, Wu Silverman of RBC Capital Markets. The bond market giving a warning sign to policymakers that fiscal sustainability issues cannot be ignored. According to Goldman Sachs, the move in the 10-year yield is nearing the pain threshold for the equity market. Let's actually ask Katie Magee about that right now. She is U.S. equity investment specialist at JPMorgan Asset Management, joining us out of London. Katie, what's your take on the 10-year yield moving up to 460, the 30-year yield moving up over 5%? How much of a concern is it?
Well, it has certainly been an interesting year for U.S. equity markets so far. Here we are in the middle of May. We're roughly flat on the year, but that masks a fair amount of volatility. We've already seen the market fall roughly 19% at the bottom, but over the last 6 weeks, we've seen the market rally by about 20%, quite a quick rally there. As you mentioned, we saw a little bit of a weaker day yesterday, and I think it's important for us to remember that there will still be a fair amount of volatility in equity markets, but important to look through that, focus on bottom-up company fundamentals, which is what we're trying to do for our clients.
Jamie Dimon says maybe a little too much complacency in that rally. Do you agree?
Well, I think overall, we came into the year in a pretty reasonable place for the U.S. market. Growth was above trend, employment had come down, inflation had come down from peaks, and the earnings that we were seeing from companies were pretty robust. We then, of course, saw a lot of fear come into the market, both around things like trade tensions, as well as things like DeepSeek. And that meant the market sold off pretty dramatically. But as you mentioned, quite a robust rally from there. Part of that has been driven by an easing of trade tensions. It's also been driven a little bit by what we're hearing from underlying companies. We're still in the middle or towards the end of Q1 earnings season. Actually, S&P 500 companies' earnings year on year have come in above what the market expected, looking like they'll grow at about 13% year on year. That's above where the market was picturing at around 7%. So a pretty robust backdrop, but I think still an element of caution. You need to think a little bit about things like valuations and navigating the market in a smart way.
So 13% is still pretty punchy for earnings growth. We've seen a lot of people downgrade expectations on the back of the Trump tariffs. Are you not concerned that that takes a big bite out of corporate margins?
Well, our underlying fundamental research analysts are out meeting with individual companies across the U.S. and around the globe all the time. Coming into the year, we had projected low double-digit earnings growth for the full year, and we thought that would also include a broadening out of earnings growth, not just seeing that strength of earnings coming from a handful of mega-cap tech companies, but actually a broadening out across industries and sectors. Now, as we've heard more uncertainty around trade tensions, we have reevaluated and underwritten those earnings. We've really thought that growth will probably slow from where it was. Inflation will probably remain a little bit stickier. There are individual things that different companies can do. Maybe some companies will take this on themselves, lower their margin. Others might pass on price, but give up market share to do that. At a top line level, we are now thinking that earnings growth for the year ahead will be something closer to about 5%, but then move back up into that low double-digit growth in 2026.
Is AI the only serious driver this year? I mean, what are the other tailwinds?
Well, AI, from a long-term perspective, we absolutely think that generative AI is the next wave of innovation, the next platform shift in technology. The same way that the internet has changed the world since the early 2000s, that mobile has changed the world over the last decade, AI will be the next wave. That said, in the short term, as investors, we need to be nimble around this, because we know that the winners of tomorrow are likely not going to be the winners of today. And a big area to think about is that we have seen a tremendous amount of capital expenditure in AI already. From the biggest tech companies, they've already spent about $500 billion in AI. They've got another 320 or so billion to come this year. The big question is, when does that start translating into revenue? That means that in portfolios, we've taken profits in some of those names that have been the big beneficiaries so far, since they've already grown so significantly, but are actually thinking about reinvesting across the broader spectrum, whether that's the data centers, whether that's the electrification companies, the heating and ventilation companies that will feed into this, whether that's utilities, or also thinking about how we can benefit from shifts and changes in consumer spending patterns, maybe finding opportunities in restaurants or off-price retailers. So a lot of interesting opportunities across the space and across styles and sectors, not just in the largest mega cap tech names that have driven markets over the last couple of years.
Katie, what if we do have a Liz Truss moment here in the U.S. driven by the big deficits that Congress is trying to pass through now? If we have a jump in yields on the 10-year above 5%, what do equity investors do? Where do you go?
Well, overall, our expectations for growth across the U.S. have come down. Now, we expect growth to slow from where it was the last couple of years. We are not forecasting, a dramatic recession or contraction here, but probably a little bit more slowing in terms of overall growth. And you'll see that already reflected in the bond markets. An important thing to think about as equity investors, though, is firstly, we're starting at a pretty robust starting point. Profit margins are at near record levels for individual companies. Companies have already gone through the cycle of rehiring those employees that they maybe let go during the COVID pandemic. So we're not getting the sense that companies are necessarily going to make significant layoffs and cuts in the labor force. And that gives us a little bit of overall stability. We're also really focused on helping our clients get invested and stay invested through the market cycle. An important stat or one to think about is that volatility is normal within equity markets. Looking back over the last 45 years, in terms of intra-calendar year declines, on average, we've seen an intra-year decline of about 14%. But that said, 75% of the time, the market ended up in positive territory. So it's important for our clients to think about time in the money rather than trying to time around market volatility.
All right, Katie, thanks so much for joining us this morning. Katie Magee there from JPMorgan Asset Management. Now let's get to the other top stories trending on the terminal this morning. OPEC Plus is looking into another supersized output hike for July. The surge in production would be to the tune of 411,000 barrels a day. That's triple the amount initially planned. The group meets in about a week, where a final decision will be made. And oil, you can see, is trading lower this morning at $60.69 on the NYMEX. Rio Tinto CEO Jacob Stausholm will step down later this year after more than 4 years at the helm. The world's second biggest miner has started a selection process to find his replacement. Shares in the London-listed firm are down slightly in early trading. And Jamie Dimon is warning that the U.S. economy may fall into stagflation. Speaking to Bloomberg at the bank's Global China Summit in Shanghai, the JPMorgan CEO backed the Fed's decision to wait and see before cutting rates.
I don't agree we're in a sweet spot, okay? And I think you have to separate two things. The economy has been doing well. All the facts, we are effectively been in a soft landing. And I've already mentioned huge deficits. We haven't finished quantitative tightening yet. There are huge geopolitical issues. There are these inflationary factors out there, and they have to react to all of that. So I think they're doing the right thing to kind of wait and see before they decide.
Coming up, the House debates President Trump's one big, beautiful bill, and we'll give you all the details. This is Bloomberg.
American people don't buy this because they know where these tax cuts are going and intended to help people at the top when it is really the people at the bottom and then the middle who need help.
The members of the SALT caucus, negotiated yesterday in good faith with leadership, with the administration, and we settled on something that we believe in, that we support. Obviously, we're waiting for the final details to emerge out of the Rules Committee, but obviously we made great progress yesterday, and I feel much better about where the bill is as a result.
And that was New York Representative Mike Lawler after capitulating yesterday, speaking on balance of power, essentially agreeing to make permanent a cap on the state and local tax deduction that New Yorkers have relied upon for over a century until 2017. He gave it up for President Trump. We are still waiting for those final details as the president's big, beautiful bill debate continues in the House. You're looking at a live shot there right now. For more, we're joined by Bloomberg Global Business Editor Josh Galoo. Josh, I guess, the bottom line here is this is a piece of legislation that is going to significantly expand the deficit. We're already looking at more than 100% debt to GDP ratio here in the U.S., and this legislation is going to blow it up potentially to 125% within the next 10 years.
Yeah, there's little to argue that that's not going to happen. This, estimates are now that it's going to add $2.7 trillion to the deficit over the course of 10 years when really Republicans and Democrats are talking about trying to lower it. And of course, as you know, coming off of the downgrade by Moody's last week, deficits are really in focus here. So, the extent to which this is sustainable and at what point the U.S. is going to have to deal with this going forward is a big question out there. The conservatives within the Republican Party on spending, they seem to have been assuaged by cuts to Medicaid that under this latest negotiation have been sped up. So they're going to kick in 2026, December of 2026, rather than 2029, notably coming after the midterm elections, because this was a massive political liability that the Republicans are now trying to avoid in getting this through. There are roughly 80 million Americans that receive Medicaid, including about 8 million children on the CHIP program. So this is something that has massive political ramifications. They're trying to push it back, and they're looking at that as one of the biggest ways of controlling spending going forward.
How much does it matter what the Congress decides to do now? Because after the House gets done with this, they have to give it to the Senate, right? And the Senate's likely to mark it up significantly before handing it back to the House.
That's right, and they've taken some steps. Senate's been lobbying pretty heavily on certain things, and and they've made some concessions. So, for instance, the most recent one is John Cornyn from Texas has gotten in this $12 billion going back to states that have spent money on border control in the past, on border security. So, they've made some concessions all along, but there's no way that this doesn't get significantly marked up in the Senate going forward. Whether or not it's going to have changes that are going to require some sort of that are going to derail it before getting it to Trump's desk in July is another question. We've already seen him come in this week and twist some arms. He's ready to do the same thing in the Senate. And of course, anybody who stands in the way of one of his biggest legislative priorities is going to face a massive political backlash.
All right, Josh, thanks very much for joining us on this. Obviously, we're going to be talking about it for a much longer time to come. Bloomberg editor Josh Galou talking about this one big, beautiful bill. OpenAI is buying the AI device startup co-founded by former Apple veteran Jony Ive, joining forces with the legendary designer to push into hardware. It's a $6.5 billion deal. It's the largest in OpenAI's history. For more, we're joined now by Bloomberg Daybreak Europe anchor Tom McKenzie, who focuses really and specializes in tech. Tom, that's your beat. So, this is pretty exciting, I guess, because Jony Ive has such an incredible reputation and OpenAI, artificial intelligence, has such potential, right?
This is quite the power couple. And if they can deliver on what they're promising in terms of potentially 100 million units, according to the Wall Street Journal reporting, with production and shipments starting in 2026, then we could look back on this moment as a significant chapter in terms of how AI is being embedded into our devices. It's a reminder of the ambitions, of course, of Sam Altman and the team at OpenAI as they push and start to nibble at the edges, not just of search, but of terms of commerce, and now on the hardware space as well. Jony Ive saying that his 30 years of experience has brought them up to this point. They're looking at a device that they haven't detailed yet, but a different form factor is what Jony Ive and Sam Altman have been talking to Bloomberg's Mark Gurman about. And again, potentially with production coming out in 2026. Ive will also be in charge of designing not just the hardware at OpenAI, but also the software as well. And Sam Altman's been quite clear in recent weeks and recent months with his frustration at the UX, or the user experience, of the chatbot and the way that their customers, consumers on the business level and on the individual level are using that, and he wants to improve that. So that's significant as well on the software and hardware front. And then, of course, this opens up questions about the challenges for Apple, Meta and others.
On the other hand, we have no idea what this is going to be, right? I mean, it's not going to be a phone. I believe they've said that. It's not going to be smart glasses, the Wall Street Journal reporting today. So what is this magical device that they're planning on shipping, 100 million of next year?
I think you have to extrapolate from Jony Ive's own career and his own products that he worked on, from the iPod to the iPhone, notably, of course. So seamless form factor, something that has very high quality and high-end components in it. You can think of glass, ceramic, high-end steel. Those elements are likely to be part of whatever form factor they come up with. As you say, the reporting suggests they want to steer away from screens. It's likely then to involve voice and interactivity with voice. Apparently, reportedly, something to be small enough that you can put on your desk, next to your laptop, next to your phone, into your pocket, something you feel that you will be attached to that has value, but also interacts seamlessly with you and your environment, with privacy controls as embedded as well. That is all speculation, but that is based and iterated on in terms of extrapolating from what Jony Ive has done in the past in terms of what's driven him. So I think that can be in focus. But again, for Apple, this really puts the feet to the fire, I think, of Apple. They have that touch point, hundreds of millions of consumers. They have the hardware. Now they need to get the AI software component right. Meta also, with the glasses, will be doubling down, you would have thought, on their wearables and devices. This is a reminder that we're getting to this point now. We're moving away from the chatbots. We're into a space where AI is being integrated into hardware.
All right, Tom, thanks very much. Bloomberg Daybreak Europe anchor Tom McKenzie talking about this OpenAI IO tie-up. Coming up, a look at what else is making headlines around the world on this Bloomberg Brief. Time now for our front page news. First up, the Washington Post and many other front pages leading with 2 Israeli embassy staffers getting shot and killed outside the Capitol Jewish Museum in Washington. A single suspect is in custody. The shooting drew immediate bipartisan condemnation in Washington, calling it an act of anti-Semitism. Next up on the Wall Street Journal, President Trump telling European leaders that Russian President Vladimir Putin isn't ready to end the war. It runs counter to what Trump has often said publicly, that he believes Putin genuinely wants peace. The White House declined to comment. And on the New York Times, President Trump confronted South African President Ramaphosa in a televised Oval Office gathering. Trump showed a video and leafed through printouts that he claimed showed the widespread persecution of South Africans. This is the Bloomberg Brief. From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Matt Miller in for Danny Berger. Let's set your agenda for the day. A bond market warning, President Trump's tax plan triggering a rough auction and a cautious tone in the markets. Wait and see. Jamie Dimon tells Bloomberg the Fed is right to hold and warns himself of stagflation. Plus, the OpenAI acquisition. The company will buy an AI device startup co-founded by Apple veteran Jony Ive, making a push into hardware. Let's take a look at what's going on in markets here. You do have bounces back from the bad trade yesterday. We were down on the S&P 500, 1.6% at the close, and 485 stocks out of 500 lost ground. NASDAQ also bouncing back up almost 0.25% now, and Russell 2000 futures up. If you take a look at some of the other assets that are driving this market, really the 10-year yield is the most interesting right now at 457.86. It had hit 460 earlier this morning, and then NYMEX crude falling as we get even more output increases out of OPEC plus. For some of the stocks to watch, let's get over to London right now. Bloomberg's Joe Easton has a look. Joe?
Hey, Matt, so the one that's really jumping out to me this morning is Manchester United, a football mover to start off. Man United losing that Europa League final in Bilbao, Spain last night, meaning they miss out on the Champions League and potentially a €2.5 billion prize pot that they could have got their hands on, a slice of that at least. And also, potentially, that's going to hit the ticket sales. It's going to hit their ability to attract new players and seal commercial agreements. And Man United falling in the pre-market, about 7% at the moment. Then we've got Snowflake over in data and AI, the company rolling out a bunch of new products using AI to harness their data capabilities, according to the CEO. The earnings showing a 25% jump in growth, and we're seeing that stock up 11% today. And then over in clothing retail, Urban Outfitters rallying as well, close to 20%. We're up 18% at the moment for that one. The namesake brand doing really well, Matt, flying off the shelves according to analysts, and a big boost for their EPS as well. Keep an eye on that one as we head toward the Open in New York.
By the way, dude, big prize missed out on by Man U in soccer, and I know you all pay very close attention to that, but the story in New York the story in New York is the Knicks loss. It was heartbreaking in overtime, and the entire city here.
I'm the wrong man for that one, I'm afraid.
Yes, well, they score points in basketball. It's a game where they actually make goals. Joe, thanks very much for joining us. Bloomberg's Joe Easton wrapping up some of the stocks to watch. Investors are pricing in a higher risk of fiscal deterioration, leading to higher yields and a potential rebellion against government debt. A little bit of a Liz Truss moment is potential. According to Goldman Sachs, the move in the 10-year yield is nearing the pain threshold for the equity market. They say that is definitely 5%, but maybe even 4.7. Let's talk about that now with Amy Wu Silverman, head of derivatives strategy at RBC Capital Markets. And Amy Wu, we saw yesterday this one big, beautiful bill, which is going to drive superinflated deficits, potentially drive superinflated deficits, rattling the bond market, a weak auction. What are you seeing in the derivatives trade?
Yeah, not surprisingly, since the fixed income market is really driving the equities market right now, you're seeing skew pick up, so demand for hedges pick up. You're seeing us cross that psychological threshold again in the VIX. And I think this kind of makes sense. If you go back to Liberation Day, what finally shook the markets was not equities, it was treasuries. And that's kind of leading in again to sort of the sell-off we saw yesterday in the rally.
My co-anchor, Sonali Basak, loves lately the term slow bleed. I prefer drip feed. We have to have this legislation now go, it has to get passed maybe today, then go to the Senate. They're going to make a lot of changes. They're going to send it back. They've got to, do a lot of horse trading. So it's going to take a while. How do you think markets are going to react to that? Because there's not one kind of mini budget moment.
Yeah, I would say it would react to me similarly to how it's been reacting to tariffs insofar as, you're kind of just stationed in this purgatory, Matt, where, you get these elevated levels of volatility. But the issue is when there are days when nothing happens, then it sort of just peters off again. And then as soon as you sort of get another data point, we can see that spike again. I call it driving around these volatility potholes, but I think we see that continuing. And obviously at the same time as we wait for news on the big, beautiful bill, we're still waiting for news on more tariff deals. And it's just a highly charged environment where these headlines will make a difference day to day.
Are these the two tails? I know you like that phrase, a tale of two tails. Are those tails tariffs and, out of control government deficits?
Yeah, I would say those are definitely part of the two tails. But, when I talk about the tale of two tails, I sort of mean the left tail and the right tail. So you've sort of seen the markets waffle between this exuberance, I would say, post-Liberation Day to, the right tail back to the left tail. I think we're kind of sitting in this left tail now. It wouldn't surprise me if, any incremental good news gets people to put that chase on again. That's the one thing that I think has been a pain trade of this market and one that you have to continue to watch for. Even when there are days of sell-offs, I think investors know that they also can't miss out on the upside. And that's what's been making this market really tricky to trade. It's made it a pickle.
So, okay, those are two, I guess, left tails, deficits and tariffs. What's the right tail?
I think the right tail has just been what we've seen post-Liberation Day, which is you saw this massive degrossing by institutional investors. You didn't see it at all from retail investors. At least round one, they were kind of right. And then the issue is because of the benchmark concentration in stocks like Mag 7, like NVIDIA, which still has yet to report, if they had to jump into the pool real quick, that's your risk to the right tail. and I don't think that's gone away either, even though we do have these two left tails to deal with right now.
What are you seeing in terms of investor reaction to this volatility? Are they selling it here? Are they buying it? Where are we in that sort of stage, in those stages?
Yeah, I would say, one thing I went out to investors with as the right tail started climbing was I just said, look, we now have the left tail again back to below average levels on a 5-year basis. Does that make sense given what we still do not know about tariffs, what we still do not know about the deficit, what we still do not know about the big, beautiful bill? So, really a week ago, post that China-U.S. news of that kind of trade going down to 30% was an opportune time to redeploy those left tail hedges. At the same time, I think, investors who have to jump back in because they degross, they're still sitting on those call buying on the right tail. But in general, a lot of times when you see volatility flag really quickly, but we know there's so much uncertainty on the horizon, it still makes sense to place those hedges, in particular with all the kind of news and catalysts that have to come out and we'll have to deal with.
But the VIX there should be more volatility on the horizon than now, right? In times of calm. And you point out the VIX finally uninverted. So we're looking at a lower VIX now than longer term options are suggesting.
Yeah, so short-term VIX is lower, but, longer-term VIX, longer-term volatility is higher. And one thing I will say is while short-term, you also saw hedges decline, the skew in S&P, so that demand for hedges longer-term also rose. It's the point the market is making is, look, we're having a difficult time figuring out when all these events are going to take place, but long-term, we are pretty nervous. I think that's the bottom line. I think that's what these metrics are telling you. And nothing has been resolved per se, right? They've just been can kicked down the road, and that doesn't make the market market feel better in the longer term. So T plus 6 months, it just makes them a little bit more angsty.
All right, Amy Wu Silverman, always great to spend time with you in your brain-bending world of derivatives. Amy is the head of derivative strategy at RBC Capital Markets. Coming up, the House debates President Trump's one big, beautiful bill, and we may get a vote soon. This is Bloomberg.
Small family farmers are in distress. Businesses can't invest. People are not hiring. You are actively crashing the economy, driving America toward a recession.
The members of the SALT caucus, negotiated yesterday in good faith with leadership, with the administration, and we settled on something that we believe in, that we support. Obviously, we're waiting for the final details to emerge out of the Rules Committee, but obviously we made great progress yesterday, and I feel much better about where the bill is as a result.
That was New York Representative Mike Lawler there, speaking on balance of power. Great name, considering what he's done is essentially sell out some more power of the states of New York and give it up to the federal government. The debate over President Trump's tax bill continues in the House. You're watching a live shot right now. For more, we're joined by Bloomberg Global Business Editor Josh Galou. And Josh, they're still talking there, but it does look like we're going to get a vote fairly soon. How much closer does this actually move us, though, to the end?
This is a massive hurdle. There's a long way to go, as you suggest, right? Getting it through the Senate. But this is a huge hurdle that Johnson has been able to appease the SALT caucus and move that cap from $10,000 up to $40,000 on state and local deductions. This is something that wasn't even, it used to be uncapped, right? And it was Trump in his 2017 bill that decided to cap it at $10,000. That was primarily then aimed at hitting Democratic states with high tax rates. But, since then, it's angered a lot of people. It has been, there are a lot of Republican representatives there that want to help their constituents. It's been a major sticking point. When it moves to the Senate, look, there are other things to consider, and there is going to be pushback, for instance, from Ron Johnson, Wisconsin, who's on the tax subcommittee on spending, because this bill will, all estimates, other than the administration's, of course, which is projecting a lot of growth to compensate, but all estimates are pointing to massive increases in the deficit over time as a result.
Let's talk about the Chip Roy faction. You mentioned the deficit, and it looks like this will add, I think, $3.3 trillion to the deficit over 10 years if the temporary measures aren't made permanent, which it seems like, well, we can see from this example that they almost always are. In that case, it would be, I think, $5.2 trillion that this adds to the deficit. Is Chip Roy, are these, deficit hawks going to be able to block that potentially burgeoning deficit, or have they essentially capitulated as well?
For now, it looks like they've capitulated because, they've gotten really quiet since the Johnson has introduced changes to basically speed up the changes to Medicaid, which are, a big part of the cuts. There's Medicaid, the work requirement that's now going to be in 2026 after the midterm elections instead of 2029. They're speeding up the cuts to clean energy subsidies. So these are the things that they're pointing to in terms of reducing costs. But, as I said before, most projections are saying this is going to dramatically expand the deficit in the coming years. So it's hard to see how people in, the Chip Roy faction, those who are really concerned about reining in government spending, how those representatives are really assuaged by this.
All right. Hey, Josh, we're going to keep talking to you about this in the coming weeks and months. Thanks very much for joining us. Bloomberg Global Business Editor Josh Galou talking about the one big, beautiful bill moving through Congress. Now, let's get to tech, because OpenAI is buying an AI device startup co-founded by former Apple veteran Jony Ive, joining forces with the legendary designer to make a push into hardware. It's a $6.5 billion deal, the largest in OpenAI's history. And for more, we're joined now by Bloomberg Daybreak Europe anchor Tom Mackenzie. He focuses in on tech. So, Tom, how much could this shake up the industry? I mean, OpenAI right now is maybe a $300 billion company. Apple is a $3 trillion company.
Yeah, this is potentially a huge threat to Apple, absolutely no doubt. But it's also a threat to other incumbents out there as well, because it's a reminder of the fact that Sam Altman and the team at OpenAI are determined to chip away not just in search, not just in potentially e-commerce, so think of Amazon, but also now in the hardware space. And that's what takes you, of course, to Apple. So absorbing the team from I.O., which, as you say, was set up in 2024 to focus on devices that can integrate with AI. Jony Ive will be independent, but will have a huge role in overseeing the design of both the hardware and the software at OpenAI. And he brings on board a number of his very, very experienced team and engineers as well. So the way that they are framing this, Ives and Altman, is that this is a marriage met in heaven, essentially. Two leaders, one, of course, on the innovation around AI, and the other, Jony Ive, arguably one of the most influential, if not the most influential designer, certainly of our generation. But they have to meet the aspirations and the ambitions they set themselves with reality. They haven't actually produced anything yet. They say it's going to happen in 2026, potentially, according to the Wall Street Journal, 100 million units. Not just one device, but a family of devices.
All right. It'll be very interesting, obviously, to see what that device is. Tom, you and I have been talking about it this morning. It's apparently not going to be a phone. It's apparently not going to be smart glasses. I know Carolyn Hepker on your radio program this morning was suggesting it could be a wand or an orb. I'm looking forward to it, as I'm sure are you. Bloomberg Daybreak Europe anchor Tom Mackenzie there on the big tech news this morning. In the world's biggest bond market, investors are pushing back against President Trump's tax cut plan. Bloomberg's Haslinda Amin spoke with JPMorgan CEO Jamie Dimon in an exclusive interview at the bank's Global China Summit in Shanghai.
You talk about that kind of complacency. I'm talking about the asset price in the United States, and it's a long list of things. It's QE, it's fiscal deficits, it's global fiscal deficits, it's potential the trade wars. It's these huge, complex geopolitical situation, and I look at all of those probably not being properly priced into the marketplace. But we don't know what's going to happen. So, I saw last night's reaction. I don't worry about one-day move in bond markets. So,
you don't worry about one day, but when you take a look at yields, they are at higher levels than they were before Liberation Day. I mean, we talked about how 30's higher. And some are talking about 10s getting to 5s, 30s getting to 7%. How are you assessing that? I mean, how high do yields have to go before they reach breaking point?
Yeah. I don't know the answer to that. No, we assess, the way we run the company is we prepare for a full range of outcomes, regardless of what you think. I just think there's a chance that you'll have stagflation. So I'm not saying it's going to happen. I don't want the reader to say he's predicting stagflation. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing. And the infrastructure needs are inflationary. Now you have offsets. You have oil prices down quite a bit, which is quite deflationary. But with all those things taking place, you may be surprised.
As we said, it is a higher yield environment. And you have said before that we could see some sort of rebellion in markets around the world. Is that still a possibility? How might that look like?
Yeah, so I would not call it a high yield environment. I mean, if you look at economic history, rates have been far higher than this, and they surprise people over time. And like I said, I think a lot of the longer term trends have inflationary attributes to them. And so the other thing for your person on TV, credit spreads are low. So you can have two things go against you, which is credit spreads gap out and rates are going up. And so we'll see how it plays out. So I don't want to guess how it plays out. I'm on the cautious side. I'm a little skeptical that we're going to have kind of just an ongoing soft landing here.
I'd be remiss not to ask you about the Fed. Given the higher yield environment, which You say it's not, but it is still higher than what it was before.
Would it go higher?
Will it go higher, and also will it force the Fed's hand?
Yes. I mean, there's always a notion that somehow the Fed is omnipotent and can do whatever it wants. And they do set short-term rates, but they also have to follow the facts. So they raised rates because inflation went up, and they can't control. Even today, trillions of dollars of these bonds are sold every day. That's done by investors around the world. They cannot control all of that. Foreigners own $35 trillion of U.S. financial tradable assets. And so, they have to react to reality, in which and that's not a criticism, they say they're data dependent, but they have to wait and see exactly what happens and then do the appropriate thing.
But the thing is, their reality is different from the reality you have in mind. If you take a look at what Neil Kashkari said, he said the U.S. economy is on solid footing. And some other Fed officials have said that in terms of Fed policy, it is in a very sweet spot. So their reality is quite different.
I think, I don't agree we're in a sweet spot, okay? And I think you have to separate two things. The economy has been doing well. All the facts, we have effectively been in a soft landing. That does not tell you what the future is going to be.
That was JPMorgan CEO Jamie Dimon speaking with our very own Haslinda Amin in an exclusive interview. Coming up, we'll get you set up for your trading day with the Fed speak and the eco data, as well as the earnings on deck. This is Bloomberg. Let's get a look at what's ahead today in terms of Fed speak. Richmond Fed President Tom Barkin kicks it off at 8 a.m. Eastern. Then New York Fed President John Williams speaks at 2 p.m. this afternoon. Plus, we get more economic data today, as we do almost every day. U.S. jobless claims coming out at 8:30 a.m. These are a favorite hard data piece for economists. And then existing home sales at 10 a.m. at a time when the spring selling season looks pretty bad. We still have retail earnings to come out. Ralph Lauren comes out today, this morning, as well as BJ's Wholesale Club, Advanced Auto Parts, and Ross Stores. All of those report today. And then in terms of individual movers, Nike, the sportswear brand, plans to sell products on Amazon's U.S. site for the first time in more than 5 years. Snowflake, the cloud software company, giving a strong outlook for quarterly sales after launching a slew of new products over the last year. And then Lumen. AT&T will buy Lumen's consumer fiber operations for almost $6 billion. I'm going to speak with the CEO of Lumen, Kate Johnson, on Bloomberg's Open Interest today at 9 a.m. New York time. We are looking at futures that are higher right now. You can see the dollar index is up as well as the 10-year yield comes down, but still at 458, and crude falls as well. That's it for the Bloomberg Brief. Surveillance is next. This is Bloomberg.